Bob, I just want to move a little bit on to your outlook on interest rates because you post some great stuff on that, and we see in real time how you have a pragmatic, data-driven view on rates. So it looks like a few months ago, the market was pricing in a number of cuts. Now it's gone to a point where the probability of actual rate hikes, not cuts, is no longer just a tail risk if you look at market pricing. So I'm just curious, at what point does the probability of hikes start to impact asset prices, do you think?
Yeah, I mean, I think we had a unique constellation of events over the first quarter where expectations of U.S. growth were very weak, and expectations were that the Fed would cut interest rates relatively significantly through the course of 2024. And then in the first quarter, um, a bunch of data basically came in and showed that the U.S. economy was pretty strong, all things considered. Even up through today's data, with very, very strong household spending. The challenge, and that was a big, important driver of why stocks rallied through the first quarter, was because growth was much stronger than people expected. But now, expectations of growth in the U.S. over the course of 2024 are now at 2.5%. 2.5% real growth in the U.S. is pretty darn strong. I mean, that's about as good as you're going to get in a late cycle environment. And so that has set expectations very high. We also have earnings growth that's expected to be 17% year over year by the fourth quarter. Those are very high expectations in terms of growth. So it's going to be hard for equities to meet that. And that's happening at the same time that there's this pressure for interest rates to rise. And I wrote something yesterday, which I said we're in a bit of an air pocket, which is that interest rates have risen enough to put a lid on the ability for stocks to meaningfully make new highs. But those interest rates haven't risen enough to create enough of a drag on the economy to shift over to an easing cycle. And so we're in a difficult position when it comes to risk assets, both bonds and stocks, because we're not quite, things are not quite bad enough to get that easing that will help, create a reacceleration, but they're not quite good enough relative to the expectations to keep asset prices going.
So if you were to have like kind of a red zone for rates, say like the 10-year, is it somewhere around the 5% range? You'd start to get worried about what will happen to asset prices?
Yeah, I mean, I think giving us last fall was a good sense of what was going on. We had interest rates touch 5%. We had stocks fall to 4,100, and that was a very short period of time and had a relatively swift response from the Treasury and the Fed to ease monetary policy, or at least indicate that they were going to ease policy. And we didn't quite get the growth slowdown that was expected, but we were on a path to get there. If interest rates had stayed at the same level and stocks had continued to decline, even modestly. And so I think those are sort of the targets when you start to get rates that are going to be, at 5% or above for more than just a moment, for months. And you start to see stocks fall something like 10, 15% from their highs. That's sort of where you start to get the types of dynamics that would typically create a turn in the economy. And we're not there yet, is the reality, both on bond yields and also on stock prices.
Gotcha. Now I just want to move on. You made a quick comment on earnings, how a lot of good times are priced in. So are you thinking it's basically earnings expectations are kind of priced to perfection? Where I saw a good chart that I can throw up that shows some of the basically the Mag 7 earnings growth versus the rest of the S&P 500. You see Mag 7 growing strongly now, supposed to decelerate but still be growing pretty well. But then the rest of the S&P will be picking up and be the strongest growth in 4Q. So does that introduce risk to you? Like, how do you characterize when you see this? Where are the risks in this type of chart?
Yeah, I mean, I think it's pretty hard. The U.S. economy is doing pretty well, but its growth is at its nominal growth is at 6% a year, which means that essentially the top line growth in the in earnings, right, the sales growth in earnings is about 6% a year. You can't really get away from that. It's not totally exactly right because they can take
Yeah,
share
actually, now let's do
from
slide 3. Next slide. This is the one that he's talking to.
they can take share from private companies. They can take share from abroad, but I think in general it's pretty darn hard to grow meaningfully earnings much more than sort of 6 to 10%. If we have that sort of 17% or 18% earnings growth, and GDP growth is growing at something like 6%, and margins are already at pretty close to secular highs, the combination of events that need to occur to get you to that 17 to 20% earnings growth by the end of the year, it's pretty tough to pencil out what exactly is going to do that. So the expectations are very, very high, considering a macro econ. They need something meaningfully better than the already pretty darn good macro economy that we've got right now.